Getting a mortgage to buy a home is one of the most important decisions that you'll ever make in your life. And that's typically because it coincides with one of the largest financial transactions you'll ever make in your life. So getting it right from the start is something you absolutely want to nail on the very first time. And that's what we're going to dive into in today's video. We're going to give you some mortgage 101, if you will. Not only going over what a mortgage is, but how to prepare for getting a mortgage. We're also going to walk you through the mortgage application process, as well as the approval process, and then also talking about the closing of your loan. So that when you're done with this video, you have a really good idea of exactly how this process works. Now, when I do videos like this, I like to really go back to the basics. So with that, we're going to start with a simple definition of what a mortgage is. A mortgage is a loan used to buy a home. The home that you're buying is collateral for the loan, which you're going to end up paying off over a set number of years, depending on what type of loan that you get. And that's going to take me into talking about different types of mortgages. So when you get a mortgage, you typically have a few different options. One option is a fixed option. And the most common when it comes to that fixed option is a 30-year fixed mortgage, which essentially means that mortgage is fixed for that entire 30 years of payment. So the same payment you make on month one is the same payment you're in theory making on the 360th month, which would be the end of that 30-year period. Now, in addition to 30-year loans, you also have 25, 20, 15-year loans. In fact, you can pretty much get a loan in any term you want, but most lenders don't do loans beyond 30 years, and that's because they don't meet the guidelines for a qualified mortgage. So when you're talking to a lender, most often you're going to get quoted a 30-year fixed option when you're talking about a fixed loan. Now, on the flip side of that, you have something called an adjustable rate mortgage, commonly referred to as an ARM. Now, these loans are typically set for a period of time, and then after that period of time is up, then the loan can adjust depending on the type of loan. A really good example would be something like a 7-year ARM. For a 7-year ARM, that loan is going to be fixed for that 7-year period. So every single month you make your mortgage payment for that 7-year period, your mortgage payment is going to be exactly the same. And then at the end of that 7-year period, typically what's going to happen is that loan can adjust one time per year every year for the remainder of that loan. And how it adjusts will depend on what type of loan it is, what index it's tied to, and what's actually happening with rates at that time. In some cases, that rate can actually go down after the 7-year period, whereas other times it's going to go up. Now, in addition to that, there are some other loan types, but those are the two most common, and I can make an entire video on that alone. But in order to keep this video timely and brief and really give you the information you want, we're going to keep it at that, because those are really going to be the most two common options that you come across when trying to get approved for a mortgage. In addition to that, I also want to talk about the differences between a pre-approval and a pre-qualification. The primary difference between the two is that with a pre-approval, you're actually providing documentation to the lender in addition to filling out a loan application or having a conversation with them, versus a pre-qualification, you might be calling a lender on the phone to try to get approved for a mortgage, and they might ask you some basic questions like how much money do you make, how much monthly debt do you have, what's your credit score, that sort of thing. And with that, they might come back and give you a number. Hey, Jeb, you're approved for $500,000 based on that information that you provided. But here's the problem with that. They didn't verify any information in that conversation, which means that conversation really doesn't hold any weight. You're not pre-approved to go out and buy a house. And that's the main difference. When you're going through this process, you really want to do the pre-approval. Not only do you want to have a conversation with the lender, which really should be the first call, going over kind of the information that we talked about a moment ago. And from there, that lender should say, based on the information that you're providing me, it sounds like you're in a position to buy a home. Hey, here's a loan application to fill out, which can typically be done online. But in addition to that loan application, we're also going to need copies of your pay stubs, copies of your W-2s, asset account statements, in addition to signing some disclosures that'll give them the ability to run your credit. And with all of that information along with that loan application, they should in theory have everything they need to be able to tell you exactly how much home you are approved to purchase. But like I said, I don't want you to get confused with the idea of having that conversation, not providing any documentation, and thinking you're as solid as the borrower that did, because oftentimes what happens in in those situations is someone gets pre-qualified, they go out and find a home, and during the process when they're actually providing that documentation that they should have provided up front, oftentimes they find out that they're not actually approved because something wasn't done accurately. Some of the numbers weren't accurate, the lender didn't do their job correctly based on the information provided, and therefore you're under contract on a home that you can't actually purchase, which in turn can be an upsetting process on top of the emotion of buying a house to start. So when you're going through this process, just make sure you're getting fully pre-approved. Now, the last thing I want to talk about before actually the documentation and things that you need in that process is where to find a lender to actually get a mortgage. This is a really common question, like where do I go to get a mortgage? Well, there's a couple of different ways you can do this. One is you can walk into your bank. If you bank with one of the big banks out there, typically that means they have a mortgage person on site that you can walk into and have a conversation. Same thing for a credit union. On top of that, a lot of people will just go on to Google and search how to get a mortgage. And there's going to be a laundry list of people that come up because all those people pay to be on Google. So you're going to get a list of stuff. But if I'm being completely honest, I wouldn't go any of those directions to start. What I would do is get a referral from someone who's purchased a home and was happy with the process. That's a really good place to start, because if you know someone that owns a home and has been through the process and they're happy with it, well, that's typically where I would start my conversation to see if I was pre-approved. And now maybe you're watching this video going, I don't really know anybody, I'm not sure where to start. Well, I actually created a link to people that I know, like, and trust in all 50 states that can guide you through that process. It's a free process, doesn't cost you anything. In fact, there's a link in the description below. Now that link is going to get you in touch with a broker. Now, how is a broker different from a bank? Well, a bank typically has their own programs. Let's look at it as a box. Now, if you fit inside this box, that lender can actually do your loan. But oftentimes, maybe your credit's not so good, or maybe you have something going on and you might not fit inside that box. And if you go to the bank, that bank may say, we can't do your loan, you're not approved. And or if they do, maybe the rate is higher than it should be. Well, that's really the big difference in a broker. A broker not only has access to maybe that bank, but typically they have access to maybe 10, 20, 50, 100 other banks that do loans. So if you don't fit in, say, box A, you might fit in box B, C, D, Z, whatever the letter is. And oftentimes going with a broker not only means you're going to end up with a better rate, but you're typically going to pay less fees because they can shop your loan around to the most competitive lender out there. But this is something important I want to know. Once you have that pre-approval from the first lender, maybe the referral link that I mentioned earlier, now go out and talk to another lender. Maybe if you talk to a broker first, now go talk to a bank. Now go talk to a credit union and compare the two. Now the key is to make sure you're doing this on the same day. If you get a pre-approval from one lender on day 1, and then you talk to another lender on day 5 or day 7, well, that probably means the rates, the fees aren't going to be the same because rates change every day. In fact, they change multiple times a day. So when you're getting comparisons from lenders, you really want to do it within a couple of hours from one another. That way you're getting comparable quotes based on the same information. And the last thing I want to say when talking about interest rates and getting quotes and that sort of thing is the lowest rate and the lowest fees aren't always the best lender to go with. You need to go with a lender that's experienced and actually knows what they're doing. Oftentimes lenders online will quote you something and then they can't end up fulfilling that promise for one reason or another. So it's very, very important to get a competitive rate and competitive fees, but it's also super important to go with someone that has experience and can actually follow through and get you to the finish line. So now that we've got some of the housekeeping items out of the way, I want to take a minute and ask a favor. If you find any value in my video at all, do me a favor and hit that thumbs up. Not only does it help the YouTube algorithm push it out to more people like you, it also helps me accomplish my goal of helping educate home buyers. And with that, if you want to stay updated on everything mortgage, interest rate, and housing related, do me a favor and hit that subscribe button. Now, when I considered making this video, I was going to talk about the idea of deciding whether or not you're even in a position to get a mortgage, but I assume if you're watching this video, you've kind of figured out your budget, you've kind of figured out, hey, I have my credit score here, and I have money for a down payment, and I've done some of the basics. Because I don't want to go over all of that in this video, but what I will say is that you need a budget. Before talking to a lender, do some of the basics, figure out how much you're comfortable spending per month. That way, when you're having a conversation, you can actually go a little bit further with that lender and tell them, hey, look, this is what I'm comfortable spending. And they can say, hey, based on that, this is how much you're approved for, versus them saying you're approved for X. And then you go out and spend X to buy a house and realize that that's way above what you should have because you didn't do your budget properly. So start with a budget. And also, one thing I want to point out in this video is your credit score is the most important thing to help you get the best interest rate and the best fees. So if you're coming into the process with a super low credit score, just wondering whether you can get a mortgage and you qualify, I would say even then, take a step back and have a conversation with that lender and ask them, hey, listen, if I got my credit score up, how would that impact my interest rate? How would it impact my payment? Because what I often see is people don't realize how important their credit score is when it comes to getting things like a mortgage, because that credit score impacts your payment more so than anything else, more so than your down payment, the type of loan you're doing, and or the type of property that you're buying. So when it comes to buying a house, really focus on trying to come in with the best credit score possible. Now, some other things I want to talk about when preparing for a mortgage is the list of documents that you're going to need when having that conversation with the lender. Now, as I said earlier in the video, you can have that conversation with the lender without providing any documentation. In fact, I think it's important to have a preliminary conversation with them, kind of tell them where you are so that they can see based on that information whether or not you're even in a position to consider applying for a mortgage. And if they come back and say that you're not, they should be able to give you some things to work on in that process so that you can put yourself in a better position once you figure out those things. But if they listen to you and say, hey, based on the information you provided, it sounds like you're in a good position to get a mortgage, like I said earlier, they're going to provide you with a loan application to fill out. Now, this loan application is going to ask you things like your name, your social security number, your birth date, your employment history, your residence history, just kind of a quick background, if you will, of who you are. In addition to that, they're going to want to run your credit score. Now, outside of that, there's going to be some additional documents that you're going to have to provide. Now, if you're a wage earner, if you're a W-2'd employee, you're going to have to provide your last 2 years of your W-2s. On top of that, you're going to have to provide your last 2 pay stubs, as well as any asset account statements that you have, like checking, savings, maybe 401ks, IRAs, that sort of thing. And if you're self-employed, you're probably going to have to provide all of that information as well as your full tax returns. And that's because the lender wants to see your write-offs. How much are you writing off based off the income that you're grossing? And with that, they're going to want to see all schedules of that tax return. Now, if you own multiple businesses, they're going to want to see the multiple businesses tax returns as well as your personal tax returns as well. So it can be heavy on the documentation side provided on your scenario, but understand lenders aren't typically asking for things they don't need. So if they're asking for a document, it's because they need it and they need to be able to provide proof of it. Therefore, that's the reason they're asking for that documentation. Now, you might be asking, I provided all of this documentation and I filled out the loan application, I've had a conversation. Well, how do they actually figure out how much I'm pre-approved up to? Well, it really comes down to your debt to income ratio. This is how lenders decide how much you can actually purchase. Now, it's exactly what it says. It's your debt versus your income. And it comes out to a ratio, if you will, but a quick example would be, let's just say you make $120,000 a year because it's easy math. Well, what they do is they use your gross monthly income. Now, that's before any taxes are taken out. You might be going, well, I have taxes taken out, so why are they using that number? It's because people have different exemptions, different things taken out of their paycheck, like, a 401k distribution, or maybe they're paying for their medical, or maybe they have a garnishment or something like that that's being accounted for. So in order to make it easy, they use your gross monthly income before taxes. Now, this is a really important reason that you budget before going through this process, because you actually know how much you take home and you can use that to base your budget off of. But in this example of $120,000 per year, that breaks down to $10,000 per month. Well, what they're going to do is they're going to compare that against your monthly debts. Now, you might be going, what are my monthly debts? Well, the debts that they're going to use are the ones that show up on your credit report. These are things like revolving debt, installment debt, things like car loans, student loans, credit cards, that sort of thing. They're not looking at your cell phone bill. They're not looking at your electricity bill, your gas bill, what you pay for groceries or childcare or anything like that. They're just looking at what shows up on that credit report. And with that, most lenders, depending on the type of loan that you're doing, want a debt to income ratio not to exceed around 45%. And now that's going to also include your housing debt as well, which means they're going to take into account whatever your new due principal and interest payment is on whatever you're buying, along with the insurance for that property, any HOA on that property, as well as those monthly debts. And they're going to take that and they're going to divide it by your income, and that's going to come up with a debt to income ratio. Now, a minute ago, I mentioned a 45% back end ratio. Most lenders don't want to go beyond that, but FHA will actually go up to a 57 back end ratio. They have a little bit different on the front end ratio, but back end they'll go 57%. So that's why a lot of people end up with an FHA loan, is because it's a little bit more lenient when it comes to down payment, when it comes to credit scores, as well as the debt to income ratio. But for today's video, let's use a quick example. Let's say you have a $500 car payment. Let's say you pay $250 a month in credit cards. And let's also say you have $250 per month that you pay in student loans. So that's $1,000 per month. Well, let's say the home that you're trying to get pre-approved for has a total mortgage payment with principal, interest, taxes, insurance, everything of $3,500. Well, what they do is they take that housing expense plus that $1,000 of debt that we talked about earlier, they add them together, that's $4,500. Well, they take that number and they divide it by your total gross monthly income. In the example that we used here, that's $10,000 per month. So if you take $4,500 and you divide it by $10,000, that's a 45% debt to income ratio. So depending on your credit scores and the type of loan that you're doing, there's a really good chance that you would be approved for that mortgage. But with that, there's something really important I want to note in this video. This is for novelty purposes. Don't go out and use the calculations that I'm giving you here to try to figure out if you're pre-qualified to buy a home. I'm giving you examples to help you walk through the numbers to give you a quick calculation. But if you're considering doing this, make sure you're talking to a professional and going through the actual process. If you need a referral to someone, there is a link in the description below. So make sure you're using that and not trying to figure this out on your own. Now, we've talked about a lot in this loan. We've talked about the documentation you need, the type of lender to use, the difference between pre-qualification versus pre-approval, the difference between a bank and a broker, a lot there, but we haven't really dove into the approval process. So in this process, you've talked to a lender, you filled out a loan application, you provided some documentation, they've run your credit, and this is really where your portion ends, at least for a small period, because what happens is now that the lender has all of this information, they need to do their due diligence to see exactly how much home you can purchase. And then one of the things they're going to do is they're going to run this through an automated underwriting engine to see if they can get an approve eligible on your loan. And if they can't, they might have to take it and get it manually underwritten. But assuming you meet the basic guidelines, are able to get that approve eligible through the automated underwriting engine, you should know whether or not you're pre-approved within a day or two of sending all that documentation in. Now, different lenders do this different ways. Some lenders can approve you the same day you submit the information. Other lenders might take a couple of days to get back to you with some information on whether or not you're pre-approved. But in no world should this take a week or 2 weeks or 3 weeks unless you have a super complicated loan that they have to go out and find somebody to do. If it's a vanilla loan where you have good credit, you have good income, you don't have anything crazy going on, you should really know within about 24 hours how much you're pre-approved up to and what your options are. And that's going to take me kind of into the next leg here of talking to that lender once you're approved. Now, I've heard conversations where lenders come back and just give you one option. Hey, you're approved for a conventional loan on a 30-year fixed mortgage. Well, that's great. But what I like to do is compare options, because what happens out there is people watch videos on different types of loan programs. They might watch a video on a conventional loan, they might watch a video on USDA, they might watch a video on FHA and think that that's the type of loan that they want, when in all reality, they should be doing a different type of loan because it ends up being a better loan with a lower mortgage payment, better rates, fees, etc. So when you're having that conversation with the lender should be giving you a couple of different options, assuming there are different options for you, just to compare different loan programs. They might compare the conventional loan to an FHA loan and show you, hey, based on this, the conventional loan is better because of this, or the FHA loan is better because of this. They should be telling you, hey, this is the loan that you have to do, because ultimately it should fall back on you in deciding which loan program is best for you. Now, in some areas of the country, depending on where you're located, different loan programs aren't available, whereas other areas of the country might not be able to go as high of a loan limit on a type of program as, say, another loan program. And that's where working with a professional really comes in hand, because they can walk you through that process, explain the differences, choices and ultimately help you decide which loan program is the right one for you. Now, one of the questions that often comes up is, how soon should I do this? If I'm not planning on buying a home for 3 months or 6 months or even a year, when should I start the pre-approval process? I would say it's never too early to start, because if there's something that you need to work on, maybe your credit, maybe you need to save more for a down payment, it's better to know sooner rather than later so that you can work on it. And just because you get approved now doesn't mean you need to go out and purchase a home. If nothing else, it gives you the confidence in knowing that you can purchase when you're ready. And something else to note on that is that a pre-approval is typically good for about 90 days. But in all reality, it's really good for as long as your information is good and doesn't really change. So if your credit score doesn't change, your income doesn't change, nothing else changes there, then your pre-approval is probably still valid. But the one thing to keep in mind is mortgage rates. If mortgage rates go up a lot, it could put you in a position where maybe you no longer qualify at all, or maybe you no longer qualify for the purchase price that you were originally looking. And on the flip side, maybe if mortgage rates come down, now you can qualify for more home. Or maybe you stay in the same price point and the mortgage payment's just less expensive based on that movement in rate. But with that, I don't think it's ever too early to start. So if you're considering buying a home 3 months, 6 months, a year, 2 years from now, it's worth calling a lender and having a conversation now so that you know exactly where you stand. So that's really it for, say, the pre-approval process, but there are some steps that happens after you go under contract to purchase a property. Now, once you go under contract to purchase a property, what's going to happen is you're going to provide that documentation to your lender, and they're going to take the original information that you sent. Maybe you have to update some of the information depending on when you sent it to the lender. If you got pre-approved 3 months ago, you're probably going to have to update your pay stubs. You're probably going to have to update your checking and savings account information so that they have accurate information. But what they're going to do is they're going to package all of that information that's associated with that property, and they're going to send it off to the bank that's going to end up doing your loan. Now, you might be watching this going, Jeb, I thought I was dealing with the bank that's going to do my loan. Well, what happens is when you talk to a broker, that broker is kind of an intermediary, if you will, between you and the bank. They're authorized to do loans through that bank, but they're not actually the bank. So what happens is when you send all that information in, they have to send it to the bank, and then the bank reviews all of that information. The underwriter reviews all the information that was sent in. They dot the I's, they cross the T's, and that's part of the mortgage process. Now, through that process, you're also going to have an appraisal ordered, and you're probably going to have to provide some additional documents along the way because the underwriter is going to look at the file and say, hey, I need some of this, I need some of that in order to satisfy certain conditions. So you're going to provide that information, and you're going to go through that mortgage process all the way to the end. And that's really the whole mortgage process in a nutshell. Now, there's a lot that happens through the process once you find the home and get into that process. But this video is really about how to get a mortgage. That's how you get a mortgage. In fact, this video really kind of gives you everything that you needed to know from A to Z. But if you're still watching this going, Jeb, I know how to get a mortgage, but how do I find a realtor? How do I find the home to purchase? What does that look like? Well, I actually created a first-time home buyer course to guide you through that process. Everything you need to know from A to Z. I go over a lot of the information that I provided today in shorter videos, in addition to walking you through what escrow looks like, how to find a realtor, and everything you need to know to really be an expert out there in the market. So whether you're buying in 30 days or a year from now, if you're looking to educate yourself, do me a favor and check that link in the description below. Now, you might be on the flip side and already be the expert, already kind of know everything that you need to know, but you're still waiting a little bit, waiting on the housing market to change, and you're wondering on what you should focus on so that you can end up with the best rate and ultimately the lowest mortgage payment. Well, do me a favor and check out this video here where I discuss everything you need to know to buy a house.